So what did you get from that FOMC that we had this week? Because I got a whole lot of nothing, honestly. Like it feels like nothing really changed.
Well, nothing really did change, right? So Powell basically what he did was just reaffirm to everyone that the cutting cycle, excuse me, is likely over. Like in from the perspective that, there's a little gas left in the tank or fumes left in the tank, but he's illustrating that the Fed does not intend on moving policy that much. Now, let's be careful when I say the cutting cycle's over. I don't believe the cutting cycle's actually over, but I do think that Powell made it pretty clear that he believes the Fed is currently sufficiently restrictive and um, more importantly, much closer to neutral at the point in their cutting cycle than maybe everyone thought they were 6 months ago when we hit the summer soft spot where unemployment started ripping, and we priced the terminal rate where the Fed was going to stop cutting under 3%, which is over 1.25% from where we are right now. So think of it like five more rate cuts were priced into the market. Um, those have been all reversed out of the market. Now we're looking at maybe two in 2025. And I think Powell basically just reaffirmed that this week.
Yeah. And I think it opens the door for another growth scare, honestly. Like we went all the way to the other end of the spectrum where all of the cuts got priced out, and now we're at a point where it's pretty evident that the market is pricing in a slowdown, and they're still at a very relatively restrictive stance. So, don't you think that opens up the door for just a growth scare, something to break, something to happen that just causes bonds to rip from here?
Yeah, like I don't think we can bring up bonds right here. I don't think that when we say something breaking is probably the best way to look at it, right? Because I think there's the reason why we're in this predicament is it's become very clear in the market that the margin to break something is much wider than everyone perceived it to be, right? We went from pricing in like nearly 75% of a recession in 2022. That didn't happen. Now we're into the low 20 we're in the 20% area of a recession, right? 10 to 20% range. So recession odds have come down significantly over the last year and a half and or 2.5 years, right? So I think that ultimately everyone was expecting something to break in 2022, and the thing that really broke was equity markets, right? They're the ones that's the thing that broke, but the economy didn't. And I think that we're in a position right now where the growth scare is a risk because you've basically taken a lot of recession fears out of the market over the last 2 years. Now, I also want to preface this with saying that a slowdown isn't a recession. That's not what the call is meant to be. The slowdown is essentially meant to be basically a pause in economic advancement in terms of uh, consecutively rising quarters of GDP where each quarter is outdoing the last, where you just have this balloon effect where you're beating expectations left and right. And a slowdown essentially is just a pause on that, basically putting the economy on hold. You're not necessarily contracting, but you're also not expanding at the pace that you were expanding at. Now, that's our base case so far for the year, and I have a feeling it's going to be that for most of the first quarter. That is primarily driven by number one, our system shows that there's just a lot of softness and growth right now, and that's the main driver for our slowdown call. And the other thing is that I do think that a lot of people are just anchored on this tariff news where they're almost hypersensitive to the fact that tariffs are going to push prices up, but not understanding that tariffs in turn also hinder growth. So I think that that's something we have to watch, going into the first quarter of this year, that it's something we haven't had to deal with for many years now, where, we can have new tariff threats or new tariff implementations on a week by week basis. And that will really, move things around economically and affect demand on the bottom line at some point. And I do think that that's pretty much the biggest risk, at least in the transition of the new administration coming online here, is just getting everything settled. And will it be perfect? I don't know. It's obviously nothing's perfect, but I do think there'll be a rhythm that's found at some point. But I think it's a little too fast at this point in time to claim that the rhythm's just set. Trump comes in and he just got the rhythm and it's off to the races. I feel like there's, if you want to call it, some growing pains that we might have to endure here.
Yeah, definitely. But I think it's pretty certain that we are in a slowdown now. Like our system was pretty good at picking that up. It's been
Oh yeah.
it's been calling a slowdown pretty much since the start of the year now. So that's a pretty solid call, and it's been pretty evident with the way the Nasdaq and the S&P has been going. Just really um, no movement higher. Just been going sideways while we're seeing utilities moving up. There was a bit of a pullback. We got a pullback on utilities, but we already saw a bounce today. So I think that was really just price action. I don't know what happened there, but someone bought a lot of utilities. So I think that was just price action there. But I think overall, like I'm expecting to see this grind higher, and then we're even seeing healthcare come out of the shadows up to Momo now. So looking for a bullish trend flip on that too. I think it would be really good to get a utilities and healthcare position to kind of get a bit of that diversification spread across those two. And then who knows, maybe we see a growth scare and bonds become a play as well and get the trio going, which that's peak slowdown play right there, is being spread across those three.
Yeah, but obviously that like a lot of work has, I mean, we're seeing the work get done on healthcare finally after just a massive dive over the last like 3 months, right? 3 or 4 months. That's a nice recovery being put in here. But like bonds, we still have to like pump 5% pretty much from here just to get to Momo.
Yeah, there's a lot of
So
work that needs to be done, but it could happen quick though. That's the thing with bonds. We've seen it
true.
before. We've seen how that works. As soon as deflation comes on the table, like I don't think anyone's thinking of deflation at the moment.
Yeah, but I think deflation is the problem with deflation is that I think a lot of people are, it might not even come to fruition in the market, right? Given that like everyone just has their hand, like they're basically shaking in their chairs on the fear of tariff inflation. So I think that there's just this herd mentality behind the possibility that prices could go up in the short term because of tariffs, that we've already seen a lot of front loading in orders, trying to basically get inventory into America before tariffs hit, because everyone's like concerned that prices could go up. I mean, you go to like regular radio stations and stuff like that. The normies, like, not to be insulting, but they really do believe that tariffs are going to materially impact the cost of their bill of goods.
Yeah.
Some people are being told that food's going to go up significantly because of tariffs. A lot of things that economically don't happen, but people are being told do. So you know how inflation works. If there's like a perception of higher prices, you tend to somewhat enforce those higher prices, right? Because if people believe prices are going to go up, you basically have this artificial demand that does push prices up, and it's not very long lived. But I do think that's the juncture we're in right now. Not so much deflation, because I do think that's that's a bit of a battle there. You have to really just take out all the inflationary wind in the market. And if we look at commodities, right? Like commodities are off their highs, but they're not. I'd say like we have to, like, this in August and early September. That's where like I think the market started picking up on like possible deflation fears. So if you want to look at it simply, right? I think if you're watching just GSG, which is the commodity index, anything under 20 on GSG, I'd be thinking like, okay, deflation fears. Anything in between 20 and 22 and 20, that range is, I'd say, just status quo. Disinflationary trend continues, and then anything above 22, which is what we saw in the last month and a half here with the pop and now pulling back, is probably headline risk acceleration there. So that's like where people start getting chatty about inflation, where people start getting a little concerned that inflation is gonna possibly reemerge out of the shadows. That's what I'm looking at. So I think we're kind of far away from from deflation, but we're actually much closer to just going back to that inflationary lull that we were experiencing the last, 4 to 5 last year.
Yeah. I mean, I'm happy as long as we don't get another cash period, which
Oh,
I
that was
don't think we
terrible. That
will.
was terrible.
Just the way, yeah, that was absolutely horrible. Wouldn't wish it on anybody, but I think I think utilities are really the play. Like I don't see anything else that's really catching my eye. Like especially the Nasdaq, it's not looking too good for it right now. Like
Like,
we yeah.
just imagine 2022, right? Like, most people listening to this, we have some members, just OG solid members that live through this, so they'll attest. But like, just imagine every day you check your brokerage account and the only thing in there is T-Flow.
Yeah.
And this goes on for like a year and a half. And
Yeah.
it's just like, you kind of lose yourself mentally because you're just looking at cash every day.
Yeah, it's not fun. It's definitely not glamorous, that's for sure. But it was kind of a good feeling, like at the end of the year of holding T flow the whole time. It's like, okay, we made 5% or whatever it was at the time. And then you just see the report of like hedge fund losses during the year. And it's like, okay, well,
Yeah.
at least we're not doing that bad. As long as
Yeah.
we're holding cash, like if everyone else is losing money and you're holding cash, you're winning. And it was that kind of
True.
year. But I really hope we don't get another year like that. Anything is possible, but I think it's pretty unlikely to get that same scenario again. Like we're gonna need inflation to pop again, which that's just not gonna happen. I know there's some bears out there that say it will, but the odds of that are next to none, especially with how conservative the Fed's been being and like holding their rates the way they are, which they played it well. I think if they did cut very quickly, like a lot of countries did, like I know Canada, the EU, they cut pretty quick. I think the Fed would have that risk again of going back into another inflation spike and another possible stagflationary period like that. But the way it stands now, I don't think that's very possible.
Yeah, interesting. Like, we're sitting here right now talking about the recent bump in inflation, or like that inflationary scare we've been seeing recently, but like, that's all headline commentary, like the Fed talking about like notable risks in inflation, right? Um Positioning themselves, like saying that like they want to, they're not, they've seen um they've seen a stalling out and movement towards target, things like that. When they say things like that, you read the headline, you have no idea what's really going on. But if you pull up the inflation chart on a year over year basis, and what you'll realize is a lot of the noise in the inflation arena comes from this little move from September of, when we were down at 2.4 to this 50 basis point move off the lows, right? But like, if you scroll out and you look at where we are right now versus like where we were in 22, like, what a just massive difference. Like,
Yeah, like there's uh, you really got to be a special type of bear to be afraid of inflation right now. I think
yeah,
deflation is what you should be afraid of. I think that's way more likely based on where the Fed is at the moment with their interest rate policy.
I could see that being an underlying, like, in the terms of having another inflationary spike versus a deflationary like move. I could see that being something. Yeah, like, I would say, I don't know. I don't want to say. Remember, like, we have to break this down to deflation, like CPI going negative. It's possible, but like, that's like damage. That's a recession, and I think that that risk is actually more prevalent right now than you seeing inflation going back to 9-10%. I agree with you there, but I do think where the call it the bread of the situation lies is like, you have in this inflation the inflation index now growing at a rate that is pretty much in line with pre-COVID. I mean, it's on the upper end, right? But like we're not like if we really look at where we were in 2018, 2011, we had these inflation spikes, and what you can see here is that inflation easily moved in 2018 from 2.9 down to like 1.5 in a matter of like 6 months. I'm not saying that there's any type of repeating pattern here or there's the path of like there's no trace line to navigate us there. I'm just saying to say that we can't get down to target in a year, I think that's very, very possible. And then, when you get down to target, you look back in time, most of the time you don't just like stop at 2%. I know the inflation 2% target was only introduced in the last 20 or so years, but the idea here is like you don't get you don't just stop at 2%. Like even 2018, we fell down below to 1.5 and we kind of baseline down there when the Fed started cutting. So I think you're in a situation here where like if inflation does you get like a 6 month move like this, you're gonna have the Fed caught completely off sides.
Yeah, and it's going to depend on how they react to that. Are they going to panic and cut, or are they going to let the waves ride out? That's going to be the
Yeah.
question, because I think as soon as we get down to just below 2%, the market's going to be screaming deflation.
Yeah, it'll definitely be the weights of inflation will shift drastically at that point. And I agree with you. Now, I also want to say that we have some underlying risks with employment. Like Powell said that the labor market's in a good place right now. A lot of basically everything's well balanced. That was the outcome of his press release. Now, I'm very interested to see how the next two NFP prints line up or come out on print wise because we have the new administration coming in. We're talking about the potential of um, unloading a bunch of unloading is the wrong word to say. I guess getting rid of a lot of government jobs, right? And we have this whole wave of private sector workforce optimization underway, where you have companies like Meta, Microsoft looking to do performance based job cuts, and this all coupled together, the next two NFP prints from here are going to be the first two NFP prints of 2025 and of the new administration. So obviously, there's been a vibe shift in the country and in the world. It's very apparent what's going on. Like everyone's kind of, I don't want to use the word waking up, but everyone seems to be coming back down to orbit, right? In terms of reality and how things should operate. And I think that that's going to kind of put a little bit of pressure on the labor market as the recalibration goes through. Now, is it going to be significant? No one really knows, but I think a lot of these estimates on what has been going on in the labor market we may have like some surprises here at least over the next two prints, and people may get confused. Maybe there's a scare in there, or maybe it's super hot. The prints are just blowout prints because companies are bringing jobs back to America. There's a lot of different things that could be happening here. I don't know how quickly they do happen, but I would say that there's a lot of uncertainties around the next two NFP prints, which will just add to the state of volatility in the market.
Yeah, and that's exactly what Powell was saying during FOMC as well. There's there's these uncertainties, and you just gotta take the information as it comes. You can't really predict it. There's always going to be uncertainties, just like he said. So
Yeah.
we just take it day by day. Same thing that we did during the whole inflation spike. No one knew how high inflation was going to get. We didn't either, but we just took it day by day. Nobody knew how high the rates are going to go. We didn't either, but day by day, looking out 2, 3 months out, we can be like, okay, rates are very evidently not high enough. It's going to be the same thing as data comes in. We take the data in and we predict a few months out, but there's no way to predict what's going to happen this year. Honestly, it's going to be a pretty crazy year.
Absolutely. And like let's just talk about like where the Fed is. Like you were saying, Powell's taking it day by day, right? So like right now, the Fed is in a position where they are holding rates up at 4.3%. So I unless unless something drastically happen, basically something breaks over the next couple of months, where we have the next meeting in March. So Powell basically laid up the market here. What he did was he held rates now without giving too much forward guidance. Remember, there was no summary of economic projections either. So there was no dots this meeting. There was no real like solid forward guidance. So the market's now in limbo mode until March. So over a month now, we're going to just be basically grinding around here trying to figure out what everyone's going to be frantically like. We have two NFP prints coming, or two NFP prints coming, possibly no, two's right, and then two inflation prints, I believe, as well, right? So there's a lot of data that can hit the tape here, and expectations may get thrown all over the place. That's what I was trying to say earlier. Like, we have a new administration coming in, a lot of uncertainties are in the labor market that'll just get basically printed on headlines, and it's going to throw expectations around, I think. And it's going to create this environment of, maybe we price in 2-3 cuts quickly, and then we come back, or we price out all the cuts, and the market gets scared and we start pricing at a hike, and then it goes the other way. But I think Powell took a lot of risk of the other way of the move, the hike side of the equation, off the table, because he said that he believes the Fed's in a position right now where they can just hold policy for longer if they have to. So he took kind of like the worst case scenario off the table. And I think that's probably why the markets resolved higher at the end of it all, because there was less of a concern of restarting the hiking cycle and more of like, okay, the Fed is in a position right now where worst case scenario is they have to panic cut. Best case scenario is they can land the rates, or they can lower the rates softly. So like, it's not so much conditions should only become looser from here type of thing, right? They're not going to get tighter.
Yeah.
And I think that's where we are right now. Like, there's going to be a limbo a phase here where, and it kind of weirdly aligns with our slowdown, right? Like, I think we have the next couple of, Q1 ends at the end of March, which is when the Fed's going to meet, right? So I think we have that window now of, do we see just this uncertainty build up in the market and the market really accelerate on that slowdown pricing? Or do we see the market shrug all this off and try and shake out higher? And I think that equities can grind up, but for some reason, I just have this feeling that I think that the defensives are going to provide some real alpha in this environment. They haven't as of right now. Well, theoretically, our slowdown call came on the 24th. So utilities have provided alpha since the slowdown call was made, but utilities don't have the full send on our behalf yet. We're waiting for a couple of more things to align before putting that trade on. However, I do think that utilities will ultimately provide alpha given we stay in a slowdown environment. If not, then obviously that's off the table. But I think utilities and even healthcare, that's right now with bonds. If bonds can get back to bullish trend too, that's the trifecta, man.
Yeah. Well, I especially just like you said, like we're entering this kind of limbo period where we have the worst case scenario off the table, and the scenarios that we have are, okay, the market is actually slowing. If it's slowing more than expected, utilities are still going to outperform the NASDAQ and the S&P. Or if, okay, the market's doing good, everything's good, everything's on track, equities move higher, it's going to take utilities and healthcare with it as well. So I think
Yeah.
like we're playing the odds here with those
See,
two trades.
that's something that I think isn't really talked about a lot, right? Because like, when you look at defensives, so defensives, there's an interest rate component to defensives because a lot of them pay dividends, right? So the interest rates matter more in defensives than they do in other sectors. But I think that we have to understand how the correlations work, right? And I think we both understand, but kind of want to break it down for the listeners. Like, when you have a defensive name like the utility sector, and you get hit with a risk off scenario. The reason why we like utilities and we like healthcare is because in an environment where you shift from an economic slowdown to a recession, utilities and healthcare can still provide positive nominal returns and relative returns against the S&P 500. Now, the issue there is there's still an equity at the end of the day. There's a risk component in there too. Like if you go hard risk off, like COVID, GFC, right? Something like that, you can't expect these equities, which is what they still are at the end of the day, to provide positive nominal returns, right? Like they're going to be negative. They'll just be less negative than the benchmarks. So they'll be relatively positive, but they won't be positive overall. And the reason to understand that and its importance there is, for the most part, we've found that utilities and healthcare do quite well even when you go into those recessionary or more severe slowdown periods. I'm not talking about crises. I'm talking about more deeper slowdowns, right? Where you get inflation under target, you get growth is near zero, things like that. Sub 1% growth, sub 2% inflation.
Yeah, and in those environments, that's when the S&P and the Nasdaq may not do so well, and then you have these safety stocks that just grind higher that whole time. So it's like
Right.
we're just taking advantage of those periods, while during those slowdown periods, it's very easy to go from a slowdown to full blown deflation, because in a slowdown environment, based on our system, a negative growth environment, which is a slowdown, uh, you just kind of have that risk that's lingering there. It's the market's in a fragile state where anything can happen, and you can't really predict it. No matter how good your model is, you're not going to predict it. But by holding utilities and healthcare, we're able to take advantage of that slowdown, grind higher. And if we do get hit with something like that, we're still protected, as you said, where the S&P might drop 5-10%, utilities are going to drop 3 to 5%, somewhere along those
Right.
lines.
That's a good case there, because what happens is like, see, the reason why we have the utilities and healthcare allocations is because if you shift out of a slowdown or into a recession, or into a positive or a risk off regime or a risk on regime, slowdowns in the middle, both these utility and healthcare holdings tend to do well either way. So you kind of are playing the odds of, like, if we get knocked around the chambers there between risk on, slowdown, and risk off, your potential to get caught sideways in a severe loss is a lot lower than, like, if you're just outright the strongest beta names out there, just the high flying beta names that just out of nowhere can drop 10-15% in a week,
Yeah. And the beauty of
20%
it
in a week.
is, too, is like you can go from a slowdown to a risk on environment very easily as well. And utilities and healthcare do well during risk on environments too. So if it's a true risk on environment and our system just is delayed by, let's say like 2-3 weeks, delayed on that risk on pivot, the NASDAQ rips, everything's ripping, at least we don't miss out on that. It's not like we're in bonds or something or in cash. Like we're still in utilities, which is going to move higher with the overall market if we do get that risk on pivot. So it's honestly the perfect slowdown trade, and
Yeah.
I think it's lining up perfectly.
Yeah, and then I know someone asked us a question about Bitcoin in a slowdown, so I think we should address that. Like, why, like, can Bitcoin advance higher, right? Can Bitcoin go up with the Nasdaq in a range bound environment? And the reason why we own Bitcoin in a slowdown is because ultimately Bitcoin is very hard to predict price for. Like, I think when you work with Bitcoin in a model or you put it in a portfolio, you have to know what you don't know. Like, to be able to move money in and out of Bitcoin efficiently, it's not possible, because the volatility, you're talking about a 60 to 70 vol, right? So you're talking about a vol environment that's 3 times higher than the Nasdaq or S&P 500. So, like, for you to claim that you can effectively move capital around Bitcoin with low volatility, it's nonsense. It's going to be volatile. Just size accordingly for that, right? And because of its nature of high volatility, those shifts from slowdown to risk on are nearly impossible to catch in an environment where you're not long Bitcoin in a slowdown, and then you get you get basically pivoted into a risk on regime, and now you're chasing Bitcoin because Bitcoin's going to essentially move real time. It's very fast the way Bitcoin prices risk in and out. So the way that we break down our model in our break down Bitcoin in our model, I should say, is if Bitcoin's in a bullish trend and we're not in a risk off environment, stay long Bitcoin. Because as long as Bitcoin's in a bullish trend, it'll trend higher with positive liquidity, with just remember, again, slowdown environments are more akin to risk on than risk off. That's very important. That's something that I think brought our models to a whole nother league when we figured that out. That slowdown environments really just they favor the equity exposure. That's why like having the utility and healthcare exposure is important because the overall risk exposure needs to be positive in a slowdown environment. And that's where I think Bitcoin has the nature of rising as long as things aren't terrible. And if you're not in risk off and Bitcoin's in bullish trend, you have to take the signal. And that's like I think somebody asked what happens if Nasdaq doesn't go up, can Bitcoin rise? And absolutely. Bitcoin can go up because they're not correlated to the exact same, like it's not lock and step. Just because the Nasdaq makes new highs doesn't mean that Bitcoin has to, and vice versa. It's a good sign if Bitcoin makes new highs for risk. And it's a good sign if the Nasdaq makes new highs for risk, but they're not one and the same. So I think that's very important to understand because Bitcoin is just leveraged at the end of the day. It's leveraged risk. Believe it or not, it is. It moves much faster, much harder than any other risk asset, both ways. So we found best in our models to have Bitcoin exposure because being able to precisely time a a slowdown regime and a risk on regime down to the day of an allocation is a fool's game. And we've actually found the returns to be far better just to stay long Bitcoin as long as you're not in a deep slowdown / recession. Risk is what we call risk off. So as long as you're not in risk off and Bitcoin's bullish trend, it's a full send on our side. But that's where we could wrap it up this week, guys. If you have any questions, feel free to reach out to us on X at the Market Radar or go to our website at market-radar.com.